Thank you for joining me today. It's great to have you. Great to see you again. Imagine you had one of these in your house. How amazing would it be? You press a button and money would come out. Obviously, you can't just take one and install it in your house, but you can have something as close to that and it would look like this. That's what we're going to take a look at today. So let's jump right in. What you're looking at is the options page for Netflix. This is called the options chain. And I'll just talk about it briefly. Basically, options. When you hear that word, you might be afraid. It sounds complex, it sounds scary, and you've heard maybe that it's very risky. And yes, it can be, but it doesn't have to be. Options are just simply future bets on the price of a stock by a certain date. We're looking at the expiration date for this options chain. Today is the 6th. So this is expiring next Friday. Every options has an expiration date. And the other important part of an options is the future price that you're betting on, the strike price. So we have expiration and the strike price. There are two types of options. There are calls and there are puts. Only two types. So it's simple that way, calls and puts. We're not going to worry about what the differences are for now. We'll talk about that in upcoming videos. And there are two other types of how you do options. You can be the buyer, you can buy the options, or you can be the seller. And the difference between being a buyer, a seller, is very straightforward. Buying is risky. Think of playing options as a gambler. Selling is a lot safer and your winning odds are a lot higher. But of course, with higher probability of winning, you have less potential to make money. Today, I'm going to show you how I make money by selling options. I don't like to take big risk. I like small, consistent payouts. I prefer base hits consistently rather than shooting for a home run on every swing. In the beginning of the video, I showed you this options chain, and the column that matters the most for us is the price of these options. All right, so let's take a look at the puts, the put options, and you can see that there are prices. When you're selling an option, so let's take a look. I think Netflix finished today at $100. Perfect. We'll just even it out at $100. And this is options that expire next Friday. If I was to sell an option, the put option, right? Looking at the price at the $100. So I'm betting that the price will stay above $100, right? Then I will get paid $1.90 per share. And it's important to know that you're selling one option at a time, which is equivalent of 100 shares, which means if you get paid $1.90 per share, you multiply it by 100 and you would get paid $190. And by Friday, if the price stays above $100, nothing happens. As soon as you make the sale, that money goes into your account. So you've already collected $190, and then you can repeat this process week after week. And that is how it became exactly the picture of that machine sitting in your house, in your home office, and you just press the button week after week. Let's look at a real life example. And this is actually a continuation of yesterday's video. And let me explain. Here's my trading account. And you can see that Netflix, I had sold on December 4th. Today's December 6th. So 2 days back, I had sold a 101 put Netflix and I got paid $47 for it. It was a very simple transaction. I sold this put, collected $47. And what this means is if Netflix finishes under $101, then I will be assigned or I will have to buy 100 shares. Remember, one option is equivalent to 100 shares of Netflix. And so at $101, that means I will purchase 100 shares, which is the equivalent of $10,100. We're going to take a look at Netflix chart, and we can see today's Friday, it finished at $100.24, which is below the 101 price that I had sold the put option for, which means on Monday, I will have 100 shares of Netflix. They will take $10,100 out of my account to buy 100 shares of Netflix. And my average cost would be 101 minus 0.47. So my average cost would be about $100.50. I had sold the put option on Thursday, and at that time, Thursday was at a price of about 103 and 50 cents. I wanted to buy this stock anyway. If I had just bought it at the price for that day, 103.50 versus 150, that's $3 a share difference. So I had saved about $300 by selling a put option, getting a sign. Essentially, I'm betting at a lower price, and if that price hits, then I get to buy this very good stock at a lower price. And if it doesn't assign me, if the price stays about above 101, then I get to keep the premium by selling that put option. So the two outcomes are I sell the put option. Outcome number one, I keep the premium. The price stays above that strike price. I keep the premium. Outcome number two, by Friday's close, the price is under the strike price of 101. I still have the premium. No matter what, you keep the premium, but I get to buy the stock that I wanted to buy at a lower price. In my books, that's a win-win. But do you see, you get paid out either way in either outcome. And so that's why I said this is your own version of that machine in your house that I showed you in the beginning of the video. Now, there's one thing I didn't show you. Here's my trading screen again. You can see that I sold another put option at $97. The price fell in market open, and when the market opened, I had sold a 97 put option and collected another 40 cents. Netflix is a great company. I use their service as I had spoken about yesterday. As long as I use them and believe in the company, I don't mind owning shares of a great company at a cheaper price. So this week I had collected 40 plus 47, $87 just on Netflix. And you can see I collected other premiums from different options as well this week. But today I just want to focus on Netflix. And that's it. It's a very simple routine. You pick out good stocks and you know the price pattern of these stocks because you've been watching these stocks for extended period of time. And looking at Netflix, it looks like it's finding a lower buy zone price at around $100 to 97 to 90. And as the price gets cheaper and cheaper, you can sell options and make money off of it, collect a premium, and that premium goes into your account right away. And this is something that you can do week after week. And this is how option sellers do it the safe way, and they generate extra cash flow income. If you want to know more in depth, then please check out the link in the description below, and it will walk you through step by step exactly how this works and exactly how I do this week after week. Thank you everyone for watching today's video. I hope it was helpful in sparking new ideas how you could possibly generate additional income. And of course, everyone, keep in mind trading comes with risk. Always risk manage to protect yourself. If you found today's video helpful, please subscribe and I will share more insights and tips in future videos. Thanks for watching, and I will see you in the next one.